Okay, so before we talk about the flexible budget, let's look at a static budget, which is this column right here, compared to actual results, which is our second column right here. And our third column are our variances. So our variances are a difference between our budget and our actuals. And variances are typically displayed as absolute values and not necessarily negative or positive numbers. It really depends on the company or the textbook publisher whether or not these are displayed as absolute values, or they may have the negative or positive in front of them. For the purposes of this textbook and this course, I'm going to be sticking to just showing these as absolute values, and then the U or the F will indicate if they're favorable or unfavorable. So in this example, again, we've got our budget column here, our actual results, and then our variances, our differences. How did we perform? Did we perform better, which would be a favorable variance, or did we perform worse than the budget, which would be an unfavorable variance? So if you look at this here, we had budgeted or planned that we were going to wash 3,500 cars. We only washed 3,400 cars, so we performed less than the budget. So our revenue for those 3,400 cars that we washed, we collected 44,200. So our actual revenue. And you can see that that's $1,300 less than what we should have done. So we have an unfavorable variance. An unfavorable variance is whenever your revenue is less than your budget, or when your expenses are more than your budget. So again, I'll repeat that one more time. An unfavorable variance is when your revenue is less than your budget, so your actual revenue is less than your budgeted revenue, or your actual expenses are more than your budgeted expenses. That's an unfavorable variance. A favorable variance is if your actual revenue is more than your budgeted revenue, or if your actual expenses are less than your budgeted expenses. So there is a section in the week 2 where there's a link to an article that talks about variances in much more detail. So you definitely want to read through that. So the big disadvantage of our static budget versus our actuals is that we're comparing apples to oranges. We're doing a variance analysis between two different volume levels. And the big advantage of flexible budgets is that we're going to be able to recast this budget amount into what it should have been for 3,400 car washes. So let's look at how to prepare a flexible budget. The first step in calculating a flexible budget is to take a look at your planning budget, which is the budget that you prepare before the period begins, and break those costs into their variable components and their fixed components. So you've got your variable expenses, wages, utilities, cleaning supplies, and our fixed expenses. And if you look at these, you can see that we've got wages and utilities in both the variable section and the fixed section. So this means that our wages and utilities are actually a semi-variable or a mixed expense, and the company went through the work of breaking it down into what proportion of that expense is strictly related to number of car washes that we do, and what proportion of that expense is fixed. If we did 0 car washes, we'd have to spend $5,200 in wages. If we did 5,000 car washes, we'd still be spending $5,200 in wages. So they've broken up a mixed cost here. Same with utilities. If you look at cleaning supplies, that's only a variable expense. So cleaning supplies, if we did not do any car washes, we would spend nothing in cleaning supplies. So our cleaning supplies are completely correlated to the number of car washes we do. And then if you look down at fixed, we've got rent. Rent is a fixed expense. There is no mixed cost to be broken out here. That means you're going to pay $14,000 in rent if you do no car washes, or again, if you do 5,000 car washes. It's not related to volume at all. The next step is to take our planning budget total and use that to calculate what our variable rate should be. And we're going to take that, and using our cost volume formula, we're going to calculate what the rate should be for each expense type. So we're going to take our total variable cost for wages and divide it by the number of car washes or number of units produced, which is 3,500, and that's going to give us a variable rate of $2.46 per car wash. So we'll do the same thing for utilities. Take our total variable cost, divide by the number of units, and that's going to give our variable rate per unit. So $1,500 is our total cost of utilities, divided by 3,500 car washes. It's going to give us a rate of 43 cents per car wash. Same process for cleaning supplies. Our fixed expenses, of course, we don't have to worry about doing that with. These do not vary with volume, so they're going to be the same regardless of our volume level. We can also do the same thing with sales revenue. As long as we're selling the same number of units we're producing, we can take our total sales revenue, divide that by the number of units, and we can get a rate per car wash. So we're selling each car wash for $13 in this example. So our third and final step in calculating our flexible budget is to recast the flexible budget so that we've got total expenses and total revenue based on the number of units we actually sold in that period. So we take our 3,400 car washes, that's the actual volume we did in this period, and we're going to multiply by our variable rate for our wages. Remember that was $2.46 in the prior slide. We're going to multiply that by 3,400 units, the number of units we actually sold in that period, and that's going to tell us that our total wages for our flexible budget should be $8,354, and we've got that right there. Same thing for utilities. We take the rate that we calculated in the last slide, 43 cents, multiply that by the number of car washes we actually did in the period. That gives us total expenses of $1,457. That goes right there. Same thing for cleaning supplies. We take that variable rate, multiply it by the number of car washes we actually performed, and that gives us what our total cleaning expenses should be. So these are what our total variable expenses should be at a volume of 3,400 car washes. Our contribution margin is just our variable expenses subtracted from our sales revenue. And our fixed costs are not changed. So regardless of how many units we do, our fixed costs are always going to be the same. So you can see that these are unchanged. This gives us a total operating income for our flexible budget of $4,274. So let's compare this to our actuals and see if our variances are different. So we compare our flexible budget to our actuals. We can see that our variances do look quite a bit different. Let's start with revenue. We actually sold 3,400 car washes. Our flexible budget was set for 3,400 car washes. We sold those for $13 each, so there actually is not a variance. The only variance that we had when we were looking at the static budget, the unfavorable variance, strictly came from comparing apples to oranges when we were looking at volume. When we recast the flexible budget, we see that we actually don't have a negative sales variance. We didn't discount a bunch of our car washes. We sold them for the $13 that we should have. If you look at our expenses, these were all favorable variances at one point. When you again do apples to apples instead of apples to oranges and look at what these costs should be at 3,400 units, you begin to see that we actually have some unfavorable variances. Our wages should have been only $8,354, and they actually were $8,450. So we've got an unfavorable variance of $96. Same with utilities, same with cleaning supplies. So we can investigate now and see what happened. Maybe we were training someone new and we spent a little more training time on them, so we had to pay a few dollars more of wages. So that's why we have an unfavorable variance. And maybe the person was new, so they wasted some cleaning supplies and training. So that could be why we have an unfavorable variance. Regardless of the reason, this gives us an ability to compare apples to apples and investigate these more fully here. So if you look at our fixed cost budget as well, you can see a variance. We had only $5,000 in wages and our budget was higher at $5,200, so we wound up with a $200 favorable variance in our admin wages. So that can be researched as well. So this concludes the lecture for this week. You can start working on your quizzes and your homework now. I do have the quizzes set up to be due before your homework because they do have questions that will help you work on your homework. So if you take your 2 attempts, figure out what all the answers should have been, why you might have missed an answer on the quiz before you go on to the homework, that should help you to be much more successful with the homework. As always, if you have any questions, feel free to email me. I'll be happy to get back to you. Or I can also see you in my Collaborate office hours, which are noon to 1 on Tuesdays and Thursdays.